Well, I think last night's statement was quite good. I was actually very concerned yesterday morning after Yellen went on the Sunday shows, and she sort of said some of the right sentiments, but it was very vague and unclear, and it didn't inspire confidence. And then last night, when they said that they were going to protect depositors at SVB and they're going to create this new facility for all these regional banks that might have basically unrealized losses on bonds, I think that was a very strong step. So I think that, you can say that maybe it took them a day or two too long. I think Friday would have been better. The sooner you nip a banking crisis in the bud, the cheaper and easier it's going to be. But I think they did get to a good answer last night. And I think now the question is it enough? And, it was still, I think, pretty disturbing this morning that you saw about half a dozen of these regional banks get clobbered, including fantastic companies like Schwab just get clobbered, and then they had to halt the trading of them. So that tells me that maybe it's not enough. And I'm sure you saw Bill Ackman had a proposal this morning where he just said, listen, we got to just come right out and say that all of these deposits and all these regional banks are protected. We can basically figure out the regulations and the FDIC later, but we need to basically go ahead and let depositors know their money is safe. I tend to agree with that.
Okay. Well, let's talk for a moment about how we got here. Lots of fingers being pointed, including at you and your friends. I spoke to David Friedberg from the production board, one of your besties in the All In pod today, about the accusations out there that investors like you guys actually fed this problem early on by raising the alarm on social media and in private channels. Here's what he said.
Listening to people on Twitter from Silicon Valley telling them what to do, they saw what happened with this balance sheet, and they went out and they moved their money out of their smaller banks into big banks. That's it. That's what happened last week. And it was the beginning of what I think we're now seeing with First Republic today. And I can tell you, I got a list of other names that I've had friends say, this is what I'm doing, this is what I'm doing. And they're all going to B of A, JP Morgan, Citi, and Wells. And they're coming out of somewhere else. And where they're coming out of already has typically 10% margin of equity to assets. That's a very narrow margin for decline in asset values, particularly when you have to get liquid really fast to fund those withdrawals. So, it could very quickly get to be a cascading problem. And that's why I think there was so much vocalness last week. I made a bet with a friend of mine on where the 10-year would end up at the end of this week. I think it's 3.5, but I think we'll end up below 3.35 by the end of the week.
Folks who blame VCs, investors, for sparking a run.
No, this is shooting the messenger. Listen, I didn't tweet about SVB or talk about it on my pod until SVB was already in receivership. And the runs had already begun on the next set of banks. The run had already begun on Signature. The runs had already begun on a number of these banks that are now being shored up by the Fed. So the bank run had already started. I mean, we were just reacting to it. We were reporting what we were seeing. And we were disturbed by the fact that the regulatory authorities in the government hadn't spoken out yet. I mean, again, I tweeted on Friday afternoon, where's Yellen? Where's Powell? Why aren't they talking about it? I think we were drawing attention to a problem that needs to be solved immediately. And I think that was constructive. Maybe nobody was listening. Maybe their actions were taken regardless. But I don't see how you can blame us for drawing attention to a problem that, frankly, the government caused. This is a classic, I think, kind of CYA tactic where they try to blame the person who's noticing the problem instead of the people who are actually causing the problem.
So how are you counseling founders on a day like today? Have you been telling them to go into so-called SIFIs, the systemically important financial institutions, the biggest banks that are too big to fail? Are you telling them to bank elsewhere in light of this failure on a more local or regional level? What are you saying to folks? Because, I mean, you can argue that the government has now created a backstop, at least for depositors.
Right. Yeah. So I think like I said, I think the actions they took last night were welcome and definitely take the pressure off. So I don't think people need to be in a panic mode. I think in terms of best practices, these are not financial recommendations, but just some of the things that we discussed with our startups are that they need to have multiple relationships with financial institutions, that they need to think about their treasury differently than their working capital. It may be okay to have your working capital, which might be 1 or 2 months of payroll, at a startup bank or something they find more convenient. But our recommendation for treasury management is to have it at a top financial institution. And you'd have to say now that the SIBs are they are safer. And part of why I've been speaking out is I would like the United States to have a very strong, vibrant regional banking community. And the problem is that if the SIBs are basically too big to fail and the regional banks aren't protected, then everyone's going to move their money to the SIBs. I think Ackman's made this point. So I think part of what the Fed needs to be doing now is letting depositors know that these regional banks are totally safe. If they don't do that, then the incentive is going to be for depositors to move their money to, 4 of these systemically important banks. That'd be a real shame in my view.